What is inflation? Inflation is an increase in prices resulting in a decrease in purchasing power over time. The rate of purchasing power decline is typically measured by tracking the average price increase of a selection of goods and services over a period of time. When prices rise, it means that the currency's value has decreased compared to previous periods. Inflation is the opposite of deflation, which occurs when prices decrease and purchasing power increases. Key points. Inflation is the rate at which prices rise for goods and services. There are three types of inflation: demand pull, cost push, and built-in. Commonly used inflation indexes include the Consumer Price Index and Wholesale Price Index. Inflation can be viewed positively or negatively depending on individual perspective and the rate of change. Individuals with tangible assets may benefit from inflation, as it can increase the value of their assets. Measuring individual product price changes may be simple, but human needs encompass a wide variety of products and services for a comfortable life. In addition to food grains, metals, fuel, electricity, transportation, healthcare, entertainment, and labor, individuals require a diverse range of goods and services. Inflation serves to gauge the overall impact of price changes on this broad array of products and services. It provides a single metric to show the increase in the cost of goods and services in an economy over a specific period. As prices increase, the purchasing power of money decreases, affecting the cost of living for the general population and potentially slowing down economic growth. Economists generally agree that sustained inflation occurs when a country's money supply growth surpasses its economic growth. In order to address this issue, the monetary authority, typically the central bank, takes necessary actions to regulate the money supply and credit to control inflation within acceptable limits and maintain a smooth functioning economy. Monetarism is a widely accepted theory that explains the correlation between inflation and the money supply in an economy. For instance, after the conquest of the Aztec and Inca empires by the Spanish, large quantities of gold and silver entered the Spanish and other European economies. This sudden increase in the money supply resulted in a decrease in the value of money, leading to a rapid rise in prices. Inflation can be measured in various ways depending on the goods and services being considered. It is the opposite of deflation, which occurs when the inflation rate drops below 0%. It is important to distinguish deflation from disinflation, which refers to a slowdown in the rate of inflation. The primary cause of inflation is an increase in the money supply, which can manifest in different ways in an economy. Monetary authorities can increase the money supply by printing and distributing more money to citizens, devaluing the currency, or creating new money through the banking system by purchasing government bonds from banks. In all cases, the purchasing power of money diminishes, leading to inflation. There are three main mechanisms through which inflation occurs: demand pull inflation, cost push inflation, and built-in inflation. Demand pull inflation results from an increase in the money supply and credit, which stimulates demand for goods and services at a faster pace than the economy's production capacity can handle, leading to price increases. Cost push inflation occurs when prices rise due to increased costs of production inputs. This can happen when additional money is channeled into commodity markets, causing costs to rise and ultimately leading to higher consumer prices. Built-in inflation is driven by adaptive expectations, where individuals anticipate ongoing inflation rates in the future. This expectation leads to demands for higher wages, resulting in increased costs of goods and services, creating a cycle of rising prices. In an inflationary economy, there are drawbacks such as decreased purchasing power for asset holders. Investors looking to protect themselves from inflation may consider assets like gold, commodities, and real estate investment trusts. Inflation can also impose costs on businesses, workers, and consumers, leading to uncertainty and economic inefficiency. Though some level of inflation is considered beneficial for encouraging spending and economic activity, excessive inflation can distort relative prices and lead to economic downturns. Government tracking of inflation through various indices helps in monitoring price changes over time, but forecasting inflation remains a challenge for making informed investment decisions.